Good morning, everyone. Today, we're presenting our market intelligence report on silver price volatility analysis and a multi-asset investment strategy. This report is an exhaustive investigation into the key drivers of silver prices, including supply-demand fundamentals, global macroeconomic trends, and geopolitical friction. Our aim is to decipher the underlying drivers of price volatility and inform tactical asset allocations across physical bullion, ETFs, and mining equities. This report covers the period up to mid-May 2026. Let's begin with our executive summary, a weekly market overview that highlights the rapid shifts we've seen. From Monday to Wednesday, we observed a significant trade de-escalation surge. On May 11th, the announcement of a 90-day mutual tariff reduction by the US and China triggered a massive wave of optimism for industrial silver demand. Spot prices jumped by over 6% in a single day, reaching up to $86.82 per ounce. COMEX futures escalated to a two-month peak of $89.88 per ounce by May 13th, underscoring silver's sensitive nature as a critical industrial commodity, particularly in solar, green energy, and EV supply chains. However, this optimism was short-lived. By Thursday and Friday, we saw a swift reversal due to a geopolitical stalemate and rising inflation concerns. Hot inflation prints quickly erased immediate Fed rate cut hopes. Compounding the drop, the highly anticipated Beijing bilateral summit concluded with zero concrete progress. This led to a spot price crash, plunging by over 9% by May 15th, trading between $75.75 and $77.11 per ounce. The primary catalyst was the absolute disappointment surrounding the Trump-Xi summit outcome, erasing all the previous tariff de-escalation premiums. For investors, this sudden adjustment offers an exceptional structural entry point, highlighting the potential for strategic long-term positioning. Now, let's break down the daily price movements and key drivers from May 11th to 15th, 2026. On Monday, May 11th, the US-China tariff reduction pact sent spot prices soaring to between $85.36 and $86.82 per ounce, a 6.8% increase, with expectations of a rapid surge in solar panel and EV cell industrial demand. By Tuesday, May 12th, prices stabilized around $83.40 per ounce, with short-term profit-taking balancing new momentum chasers. However, Wednesday, May 13th, brought new challenges as US CPI came in at 3.8%, destroying June rate cut odds, and India surprisingly raised its silver import tariff to 15%. This pushed futures to $89.88 per ounce. On Thursday, May 14th, the US PPI accelerated to 6.0%, and the US 10-year yield surged to 4.41%, reinforcing a globally dominant US dollar. Finally, Friday, May 15th, witnessed a significant downturn. The Beijing US-China summit ended with no concrete progress, leading to a massive liquidation that completely erased all weekly gains, with spot prices plunging to between $75.75 and $77.11 per ounce, a 9.5% drop. A major contributing factor to the market shift was the geopolitical US-China-Beijing stalemate. The Trump-Xi summit, held in Beijing from May 14th to 15th, failed to deliver on its promised trade breakthrough, severely dampening market sentiment. Despite U.S. claims of a major Boeing purchase commitment, Beijing refused to issue any supportive official announcements, indicating a lack of unified progress. The summit effectively became a zero-sum confrontation, with a deadlock on key issues including Taiwan arms sales, regional security, and advanced USAI chip export restrictions. This supply chain friction is particularly concerning for silver, as its industrial demand, which accounts for approximately 55 to 60% of total demand, remains deeply tied to trans-Pacific supply networks. This raises significant concerns ahead of the November tariff deadlines, indicating ongoing volatility risks. Concurrently, macro-finance factors also played a critical role, leading to inflation and a rate cut collapse. We saw significant yield spikes and persistent inflation. US CPI outperformed expectations at 3.8% year-over-year, largely driven by rising tensions in the Middle East, which pushed energy prices higher, with WTI crude reaching $98.25 and Brent crude at $104.41. This led to a hawkish shift in market expectations. The probability of a June Fed rate cut dropped under 8%, with major institutions deferring their policy ease forecasts to September 2026. These developments created significant yield pressures, with the US 10-year yield rising to 4.41%, increasing real yields. High real rates typically spark liquidations in highly volatile monetary assets like silver, as investors seek less risky alternatives, further contributing to the price decline. Adding to the market turbulence was a significant regulation and demand shock: India's tariff hike. India suddenly raised its silver import duty from 6% to a substantial 15%. This move caused immediate disruption in what is the largest physical silver market. Domestic prices on the MCX briefly hit 304,177 Indian rupees per kilogram, as the immediate 15% tariff shock crippled industrial and jewelry import margins. Furthermore, to stem capital outflows, the Indian government moved silver imports from the free category to restricted on May 17th. This had a global domino effect. MCX prices plummeted by 11% over just 2 days, and the sudden freeze in Indian physical bidding directly dragged down both the London and New York spot markets, underscoring the interconnectedness of global silver trading. Despite these short-term macroeconomic volatilities, the underlying truth is that physical silver remains in a persistent 6-year structural deficit. Cumulative inventories have dropped by a staggering 762 million ounces since 2021. For 2026, both the Silver Institute and Metals Focus project deficits ranging from 46.3 million to 67.0 million ounces, with aggressive scenarios showing deficits up to 215 million ounces. HSBC Global Research projects a 73.0 million ounce deficit. This is driven by core supply inelasticity and robust industrial demand. Global mining output is projected to grow by just 1% to 820 million ounces, while high-tech applications in AI data centers, biosensors, and solid-state batteries are rapidly outpacing thrifting efforts in the solar sector. While higher prices may curb jewelry fabrication and encourage miner recycling, which stands at around 216 million ounces, supply remains highly inelastic because approximately 70% of silver is mined as a byproduct of other metals like copper, lead, and zinc. Turning to valuation, we often look at the gold to silver ratio. This ratio is calculated by dividing the gold price in USD per ounce by the silver price in USD per ounce. We define a green zone at less than or equal to 50 to 1, where silver is considered exceptionally undervalued compared to gold, and maximum portfolio weight in silver is recommended. The amber zone is between 50 to 1 and 80 to 1, representing a neutral trading range. We saw compression peak at 55.25 to 1 on May 11th before expanding to 59.00 to 1 by Friday's close, indicating silver became slightly more undervalued relative to gold by week's end. Additionally, when looking at the silver to Dow ratio, which currently stands at 659, compared to historical extremes like 18 and 1980, it strongly suggests that hard physical silver remains highly undervalued relative to financial equities, presenting a compelling long-term opportunity. For investors looking to gain exposure to silver, there are several key investment vehicles. First, physical ETFs and ETCs are efficient instruments that track spot prices directly without the high storage premiums associated with physical bullion. Examples include iShares Silver, with $35.6 billion in AUM and outstanding liquidity, and Invesco Silver, a premium European product with low expense ratios. Second, select primary miners offer operational leverage to rising metal prices, often outperforming spot silver during bull runs. Silvercorp, for instance, has outperformed year-to-date by 75.87% and boasts a debt-free balance sheet. First Majestic is another pure silver play with solid resource expansion. Finally, royalties and streaming companies provide upside exposure while protecting capital from mining inflation and country risk. Wheaton Precious is a $67 billion titan in this space, offering high margins and protection from rising operational expenses through its unique business model. Based on our analysis, we've developed two scenario-based portfolio allocations. Our base bullish scenario, with a 60% probability, assumes that the Federal Reserve begins rate cuts by autumn 2026, trade partners agree to a transitional tariff truce, and Indian demand normalizes. In this scenario, we target spot prices between $70 and $100, and for Japan, 400 to 700 Japanese yen per gram. We recommend a 50% allocation to physical silver ETFs like SLV for direct liquidity, 30% to royalty streams such as WPM for robust operational insulation, and 20% to top-tier miners, focusing on SVM and AG. Our hyper-bullish scenario, with a 25% probability, envisions the Fed aggressively easing, AI-led infrastructure driving high-tech fabrication demand, and physical vault exhaustion triggering a short squeeze. In this more aggressive scenario, we target spot prices between $100 and $135, and for Japan, 700 to 1,000 Japanese yen per gram. Here, we suggest a 40% allocation to junior and mid-tier miners for high beta exposure, 20% to junior miner ETFs like SILJ for broad sector leverage, 20% to leverage ETFs such as AGQ, and 20% to physical silver for short-term tactical allocation. Thank you for your attention. We are now open for any questions you may have regarding allocating capital to navigate the growing physical deficit in silver markets. You can also find more information on our website or reach out to us via email. Here are the image sources used in our presentation. We have utilized images from Google User Content. .com for global diplomacy and trade, and another from Google User Content. .com for fine silver bullion stacks. Continuing with our image sources, additional graphics were obtained from Vecteezy. .com for the geopolitics visual and iStock photo. .com for the silver bullion bar image. Thank you.